Good evening and welcome to week 3 of GRA's 2023 webinar update series. Welcome Anthony Lipscombe joining me here this evening for a tax update. Be fair to say that the tax update that we did in May, there's a fair bit of repetition in this webinar tonight, and that makes sense because in 3 months that much has not really changed. So the format tonight is my colleague and partner here at GRA, Anthony Lipscombe, will lead the presentation. I'll run Q&A and control the question and answers, and I'll probably do the political side of it because we've got a quick analysis of what the politicians are saying of their taxes, so I'll do that bit. But for the most part, you have Anthony Lipscombe for the presentation this evening. Just running through a few preliminaries. As I'm sure you're well aware, taxation and other legislation changes over time, and this presentation is current as at August 15, 2023. And what we find is that clients can watch these presentations many months or even years later and get confused because they rely on the information as being current, and it's become, of course, out of date as the laws change. So just be aware if you're watching this in the future, the laws can change, and that's been happening rather rapidly in New Zealand. So you should check before relying on any of the material in this presentation that nothing has changed post the presentation. Another thing is everything in this discussion this evening is generic. It's not intended to be specific advice, and viewers that are watching this presentation should be cautious to take their own advice that's applicable to their own individual circumstances and not rely on the generic concepts in this presentation this evening. So without further ado, for those of you that don't know me, I'm a chartered accountant and a tax guy and a property guy, and I'm the host of this webinar series. And my colleague, Anthony Lipscombe, who many of you will know, is a trust and legal structures expert. He's a partner here at GRA. He runs our tax team. He's a chartered accountant and a lawyer. He's been a bit of the bar. Welcome, Anthony.
Thank you.
Once again. The agenda we have this evening is we're going to run through the trust tax rate change to 39% that Labor have proposed from 1 April 2024 next year. I go through interest non-deduction changes and implications, loss ring fencing, rollover relief, and restructuring implications. And if some of these terms don't make sense to you, don't fear, we'll explain them to you as the presentation goes on. We're going to bring to your attention a change of use issue for GST, which has been affecting some of our clients recently and has blindsided us. I think it's new policy from IRD that they're having a run with. We think it's bad policy, can affect some of you. And we're going to give you a bit of a trust update and recap of the trust law changes that have been coming through. So Anthony, welcome, and you should have control, so please take over and tell us what's going on with the trust tax changes.
Okay, thanks, Matt. When the May budget was read, the government announced an increase in the trust tax rate to 39%. This was not a huge surprise. In fact, the most surprising thing really about the trust tax rate was that it was not raised to 39% almost 2 years ago now, when the highest personal marginal tax rate was increased to 39%. That would seem to be pretty accepted tax legislative policy to try and ensure there are not arbitrages between different entities, and it was quite astonishing at the time that the trust tax rate was not increased in line with the personal rate, but that's what happened. And then in their wisdom, the Labor government decided to conduct an investigation to really reveal what was going to be obvious as an outcome of leaving this gap between the trust and personal rates. They decided to conduct an investigation to see if there was going to be exploitation of that gap, and introduced trust disclosure rules. And then, unsurprisingly, they concluded, well, actually, it's not a good idea that we didn't increase the trust tax rate to 39%, so let's do that now. What this means is that from 1 April 2024, if you have a trust that derives income, the income that's retained in the trust is going to be taxed at 39% rather than 33%. Current trust tax rate's 33%. If you then think about what sort of income comes into a trust, trusts derive dividend income, for example. That means, whereas today, if a trust receives a dividend, by the time the company pays tax at 28%, by the time there's resident withholding tax deducted from the dividend at 5%, the trust doesn't have any further tax to pay. From 1 April 2024, if a trust receives a dividend in the same circumstances, it will have an extra 6% of tax that it will have to pay. And here's an example that shows the amplifying effect of a number of changes that have occurred in the last few years, as well as if we think about the economic environment that we're operating in. So what we've got now is a convergence of a number of different factors that really put property investors, say particularly those that hold the property investment via a trust, at a great disadvantage from where they were, say, a couple of years ago. And when I talk about convergence of factors, what I'm talking about there are the inflationary environment, which sees cost of living increase, cost of investment, maintenance of an investment property in terms of rates and insurance and those sorts of costs increasing, a high interest rate environment. And then we layer on top of that the interest limitation rules, which have now been around for a couple of years, but are only now really starting to bite. Most people who are familiar with those rules will understand that they are being phased in over a 4-year period, and we're now into year 3 of that 4-year period, meaning that 50% of interest costs are no longer deductible, and we're on the slippery slope down to 0, so that from 1 April 2025, interest is not deductible at all. And if we put all of that in the melting pot, if we think about the trust tax rate moving to 39%, we think about the inflationary environment we live in, which means that, say, personal tax, everyone's going to end up paying more in personal tax, even though the personal tax rates are not at the moment projected to increase. If there's a change of government, there might be a decrease, but without the tax rates decreasing, everyone's going to be paying more tax because salaries are going up. So we end up with more tax to pay, less in the hand, higher cost of living, higher interest rates. And if you happen to have a property held in a trust, then this is a slide that really illustrates the stark difference between what the position used to be prior to all of these rule changes versus what it is now. And so what we have here is a rental property, or in fact, it looks like it's a rental portfolio, 3 properties producing $35,000 in rental income, cash flow of $105,000. There's OPEX per property, $7,500, meaning that after OPEX costs, we've got a net yield of $82,500. There's $1 million of interest-bearing debt here, subject to 7% interest, 1.5, I should say, of interest-bearing debt subject to interest at 7%. And if we then deduct the interest from that, we've got negative cash flow of $22,500. Now, in the old rules, that would be the end of the matter as far as tax is concerned. You would have a loss and there would be no tax to pay. That loss would be ring-fenced. Another Labor government initiative of the prior coalition government, that one that dates back to 2020. But there would be no tax to pay and the loss would be available for offset against future rental profit. Now we contrast that with the position post 1 April 2025, so into what we call the financial year 2026. We've got the same cash flow coming in, we've got the same OPEX, we've got the same net yield, we've got the same interest costs, which means we have the same negative cash flow pre-tax of $22,500. But now, given that interest in 2026 is entirely non-deductible, you end up with a taxable profit, a magical taxable profit in a scenario where you are negative cash flow $22,500. So you end up with a $32,000 tax liability in this scenario based on the 39% tax rate. So you can see how the changes over time really get amplified in effect. And what was a negative cash flow of $22,500 with losses to carry forward now ends up with negative cash flow of $55,000, which is obviously very significant. And you end up with a $32,000 tax bill on a $22,000 negative cash flow position, which really in the mind of, I think, most reasonable people would seem to be a highly erratic result, and illogical, maybe that's the better word, a highly illogical result to have such a large tax bill despite you not making any money.
Yes, and when these rules came in, Anthony, I was furious. I think it's the only time in a webinar I've ever thrown something across the room. I was so angry. I couldn't speak. I was so upset about it because Grant Robertson told us no new taxes other than marginal tax rate going to 39% in the second term of Labor. There would be no new taxes. And then he blithely said that this wasn't a new tax. It was just an adjustment to the existing tax regime. So, yeah, there was a lack of transparency there. And I said at the time, I blogged it and in my webinar said it, that when it came to the election year, we would be very forthright about pointing out that they lied to us about this. They were not transparent at all. It was clearly their intention to change the tax system, but they didn't forewarn us in the last election. So we couldn't vote on it, and I'm still very upset about that. Another thing about these tax hikes is that we're getting bracket creep with inflationary costs and salary increases, Anthony, because of course inflation causes tax to increase despite there being no real increase in income in a CPI adjusted sense. So no change to the tax rate, but an increase in income to cover inflation means an increase in money to the government. So it's that bracket creep is that without increasing tax, they get more just through the inflationary effect. And I don't think that's a good thing. That they should see in an inflationary environment that taxes actually should be coming down. Sorry to cut in. So you were talking about trusts and background discussions there.
Yes, what we'll do is we'll just take half a step back here, because in order to get to a point where we can talk about what measures you might take to adjust to the 39% trust tax rate, let's take a step back and look at how trusts are taxed. When a trust derives income, you have two choices. It can either be treated as what we call trustee income, which then means it is subject to the trust tax rate of 33%, or it can be distributed to beneficiaries. And if income is distributed to a beneficiary, then the beneficiary's tax rate applies. And for individuals, you can see on the slide here, we have tax rates ranging between 10.5% at the lowest end of the scale to, of course, 39% at the top rate. The key point there being that the trust tax rate only kicks in if income's not allocated to beneficiaries. So here's an example of this in action. We've got a trust that owns the shares in a medical service company. That company makes $1 million in this example. After paying company tax of 28%, that leaves it with $720,000 on which of after-tax earnings, out of which it can declare a dividend. If a dividend were declared based on that, there would be withholding tax to pay of $50,000, meaning that if we start with the $1 million and then we deduct 28% company tax rate, 5% withholding tax on the dividend, we end up with a net position of $670,000 of net after-tax income, and the trust doesn't have any further tax to pay. The trust in the year to 31 March 2024 is subject to a 33% tax rate. It ends up with $670,000 after tax based on the dividend. If we contrast that now with the position after 1 April 2024, there will now be an additional 6% of tax payable, so that instead of the trust having net $670,000 after receiving the dividend, it ends up with $610,000. There's additional 6% payable. So the impact, I think most people will grasp that the impact of the trust rate going from 33% to 39% means that you're taxed an extra 6% on trust income. Remembering what we mentioned just a moment ago, that there are two choices available to you when you have income in a trust. So what could somebody do to try and reduce the impact of tax when they have, say, trust income of that sort of quantum, or in fact of any quantum, but we're going to use $1 million because it's a nice round number in this example. Same scenario, trust owns shares in a medical service company, but this time instead of all of the dividend income being treated as trust income, what we're going to do is distribute income to beneficiaries. And if we've got beneficiaries who are earning no income from other sources, then any trust income that is distributed to beneficiaries is then taxed at their rates rather than the trust rate of either 33 or 39%, depending on when that happens. So in this example, you can see that there are 3 beneficiaries who receive distributions: 2 children and a spouse. You will note that when we refer to the children there, that we have specified that they're 16 years old and 17 years old, and there's a reason for that. Unfortunately, for those of you with younger children who might have a trust and think, well, I'd really like to allocate income out of my trust to my 2-year-old, unfortunately, you cannot allocate more than $1,000 on a tax effective basis to a child that's younger than 16. You can allocate exactly 1,000 or less than 1,000, and it will be taxed at their rate, but anything more than that, and it is treated as effectively trust income and taxed at the trust rate. But once your children are 16 or older, then it's game on. You can allocate income to them. And in this example, $210,000 of the dividend income is allocated to beneficiaries, $70,000 each. And the tax that they will pay on that is based on the personal rates and the weighted average, bearing in mind that the tax rate for the individuals here starts at 10.5%, moves to 17.5%, moves to 30%. On income up to $70,000, the weighted average of those 3 bands is 20.03%, and we end up with only $42,000 being paid on that $210,000. That will leave us then with $790,000 of trust income, which is then taxed at 33%. So overall, whereas in the previous example, where all of the dividend was treated as trust income, you may recall that $670,000 ended up being the after-tax takeaway income. With the benefit of splitting income to beneficiaries, we end up with $697,000, so a relatively material increase in the amount of after-tax take-home income there. Now, same example, in a world where the trust tax rate is 39%, we have $1 million coming into the trust, we have allocations of beneficiary income to 3 beneficiaries. There's going to be no difference in terms of the tax those beneficiaries pay from 2025 onwards, unless there's a change in the personal tax bands, which Matthew has just advocated for, but at the moment we'll assume that's not happening. On the income retained in the trust, we're now taxed at 39%, but whereas in the first example we gave you, all of the $1 million dividend was taxed at 39%. In this example, it's the $790,000 after the beneficiary income distributions have been made. We still end up with a lot more tax being paid as a result of the rate going up, but the effective increase this time round is 4.7% rather than 6%. If we go back 5 minutes, where we had a trust receiving a dividend and not allocating income to beneficiaries, the impact of the trust tax rate increasing meant that there was a 6% uplift in the amount of tax that you pay. Whereas if you can distribute income to beneficiaries, that increase is not going to be quite so severe.
This is a moment where I wanted to talk to you about the beneficiaries' position. So you start allocating income to the beneficiaries like this. The beneficiaries have rights, don't they? They've suddenly got $70,000 that is owed to them. How do our clients who are making these income distributions make sure that the kids or whoever it is they're allocating the income to don't then demand the money back as soon as they become sui juris and of age to be able to demand the money?
Exactly. So great point. These allocations of beneficiary income to your 16 and your 17-year-old are real. This is not a notional allocation of funds that has no substantive impact. In order for the tax to be paid at the child's personal rate, there needs to be a real distribution of income. Now, that doesn't mean there needs to be a real payment of physical cash. There can be an acknowledgement that the trust owes the child money, but again, that's real. And that means that, as Matt has said, you might get a knock on the bedroom door once your child turns 18 saying, oh, I see that you've allocated 2 years of beneficiary income to me, and I've discovered this really great crypto investment opportunity that I'd like to get into, or maybe I've negotiated the purchase of a souped up car on Trade Me, whatever it might be. They're knocking on your bedroom door and wanting to get payment of those funds. So what often happens in these situations is that the trust may be paying expenses beyond the sort of obligated costs of food and shelter. The trust may be paying for tertiary education costs, for example. And if that's the case, those expenses are then offset against the amount that is owed to the child. And that way you can reduce the amount owed organically through the payment of expenses. Might be that there's travel, maybe there's a trip that the trust has funded overseas. Another thing that often comes up is that there is a desire to help the child perhaps get into property. And so that would be a way of applying the funds that have been allocated to them in the past to a productive purpose. They could be advanced to them and put towards the purchase of a property.
Yep.
In the end, what you don't eliminate will still sit there as a balance owing and eventually will come out, but that won't be so much of an issue if it sits there sort of as status quo, and eventually, no doubt, the intention will be, when you've lived a long and fruitful life, for the assets of the trust to pass to your children, so then organically any money owed to them will form part of that. Point to take away is that the allocation of beneficiary income is not a notional thing. It can be called up, and it will be, I guess the last point here, Matt, is that perhaps I was being overly facetious with reference to the knock on the bedroom door and the child wanting money. Perhaps a better example of the consequences of having money owed to your child that you need to bear in mind is that is then part of their personal asset base. And if they get into creditor trouble, or if they are in a relationship that dissolves after it's fallen within the ambit of the property relationships legislation, then the money owed by the trust to them is an asset that's vulnerable to those sorts of risks. That's another factor to bear in mind here when making those allocations and ending up with a large amount owed to children.
There's some practical comments here to make too. If your kid's threatening to call up a loan to the trust, you would probably turn around and say, well, that'll be the last dollar you get out of the trust. If you're going to behave like that, we'll remove you as a beneficiary. So you can fight back if that becomes a factor. Another thing is, you mentioned that most trustees will want to help their kids into property. And so that's a great use of the money, is to give them an allocation, use these allocations to eventually give them a deposit on a house. And that's another good use of the money. Paul says he has a side agreement with his 17-year-old boy who gets a $1,000 payment and he gives the balance back to me. So he's annually gifting the money off. That's innovative, Paul. Jeff says, to clarify, my understanding is that the cash not paid that has been distributed is that an unsecured loan by the beneficiary, or does it sit in the beneficiary current account? Same thing, Jeff. An amount sitting in the beneficiary current account, is it call? The beneficiary, once they're 21, they can call up that as an unsecured loan to the trust and say, we want the money back. So that's exactly the issue we're discussing right now. And managing that, as Anthony's just prudently said to you, you want to allocate all costs above your parental responsibility and to the trust as being drawn from the kids' distributions. So private school fees, university fees, travel, a deposit for any property, all that stuff. You got to give them board, lodgings, education, and a public school education. But anything above that, you can draw out of that beneficiary current account as drawings to the kids. Just keep a list of it. But it's something to be aware of because there is a risk in it, as Anthony has just highlighted. Back over to you, Anthony.
Okay. The company tax rate is not changing. That's a point worth highlighting. And expectations are that it is unlikely to change anytime soon. And that raises a question. So we've just run through a couple of examples where dividends were declared from a company owned by a trust, and the declaration of the dividend triggered the extra tax payable. So you're probably watching that and listening to that and thinking, well, why would I declare dividends from my company if I can cap tax at 28% and just retain the money in the company? And that's a very good question, because deferring the declaration of the dividend means that you don't trigger the payment of 5% withholding tax. You don't then have an additional 6% to pay in the trust on top of that if it can't be allocated out as beneficiary income. But that raises the question, what if you want to get money out? How can you accomplish both of those things at the same time? And that's very difficult, and in some instances not possible. For example, if you had a company that made $1 million, paid tax at 28%, leaving it with $720,000 of available surplus, and instead of declaring a dividend, it loaned it to the trust, you might think, well, there we go, I've managed to achieve alchemy there. I've gotten hold of the cash and I haven't triggered the payment of withholding tax because I haven't paid a dividend. Well, the catch there is that a loan from a company to a shareholder, or even to an associate of a shareholder, generates a deemed dividend. So invariably what happens is that the company does have to charge interest on the loan, which means it accrues interest income. It's accrued at a deemed rate set by the IRD, so 7.89% in this example. That was the rate for the first half of this year. And that would mean that the company has $16,000 near enough of tax to pay. So not a very attractive way of sidestepping the declaration of a dividend.
Be worth noting that if any of you have old school qualifying companies earning income, you can you can have an overdrawn current account, can't you, Anthony, without attracting deemed dividends. Is that right? I seem to recall the QCs don't tax you on overdrawn current accounts because it's a non-cash dividend. So you can earn income in the qualifying company, pay tax inside it because it's not an LTC, it's not transparent. So you end up with the marginal tax rate of 28% and then pull the money out without paying the top-up tax. Is that the way QCs work?
Yeah, correct. There's the QC's dividends are exempt. So yeah, you don't have
those of you with those legacy entities that are grandfathered meaning that they won't allow us to create any more, but you still have them. You know, there is an angle there to create alchemy, as Anthony said, and move business income into them, and you can get it out without paying the top-up tax. There's probably some tax avoidance arrangement in what I just said, but you know, some of you might be able to make use of that. It's useful information if you've got those old QCs or LAQCs, same thing, floating around. If you didn't transition them to be LTC or revoke the election that you'd made. Probably getting a bit irrelevant these days. Most people don't have or can't even remember the QCs.
Yeah, going back there certainly won't be many of them kicking around, but yeah, good point to make. Want to show you a slide now with an example of where money could be applied to a productive purpose without a dividend needing to be declared. And that is in the context of a wholly owned group. A wholly owned group is where you have two or more companies with identical shareholding. And if you have that scenario and you have, again, a company that has net surplus after it's paid company tax, instead of declaring a dividend, if you wanted to apply that money in this example towards reducing rental debt, you could have an advance without consequence from a tax point of view from the profitable engineering company to the rental company, and then the rental company can use the money to reduce debt. In this example, $720,000 can be used to reduce rental debt without there being a dividend. The engineering company pays tax on the $1 million it receives at 28%. You get use of the money outside of the engineering company, and no dividends declared. Now, I do want to hasten to point out, this is not creating a permanent tax saving. We're not performing David Copperfield type magic tricks here. We're not capping tax permanently at 28, but what we are doing is kicking that can down the road. We are showing you an example where you can productively use tax paid profit for a purpose outside of the business without the necessity of triggering a dividend. So not necessarily applicable to everybody, but definitely worth looking into if you have multiple companies, one or more of which is profitable and producing surplus cash that you don't necessarily need to retain and reinvest in that particular business. Yeah,
so if you were to declare that dividend, you'd have another $110,000 of interest of tax to pay, or thereabouts, up to 39% on the new trust tax rate. And instead, you're able to take that $110,000, pass it through to the rental company, and so you're getting a 7% return on the government's money on the tax, and that's in perpetuity until you decide to declare the dividend later. So that's going to be the compound interest on that is going to be very significant. So yeah, that's an excellent structure. And if you read Tax Structures 101, which we published in 2013, and if you go back further to the beginning of time, if you're an old client of GRA, we've been running that structure for, since the beginning of time. It's a robust structure. There's no challenging it. IRD have never challenged it. That is just mainstream Kiwi tax structure. It's an oldie but a goodie, and well worth understanding and utilising that structure. Probably be the most common structure we use, for our business clients who are in property. Mm-hmm. Anthony, that is valuable. Thank you. So I wanted to discuss briefly the political landscape, and there's no news here. I mean, the Nats are holding their cards up. ACT are being very transparent, and Labor and Green want to get stuck into us and tax the hell out of us. And I want to pause for a moment and say, I got an email from one of our listeners and viewers, and he said, Matthew, you need to be inclusive and impartial. And I wrote back and I said, no, I don't. That's the joy of being a director in a chartered accounting practice in a private organisation. I don't have to be non-biased and inclusive. I can be a chartered accountant representing the right, and you know, I'm a right-wing, you know, political person. I very transparently say to you that I'm a National Act voter, always have been. If you want a commentator that wants you to pay more tax, wants you to have less wealth, and that, you know, is not trying to increase your wealth, well, then you shouldn't listen to me. You should hang up and go somewhere else, because I'm all about reducing your taxes and increasing your wealth. You know, that's my brand. So I'm not trying to be unbiased, and therefore I'm not going to tell you about Labour and Green, because I don't think New Zealand's on the right path with what they're saying and doing. I'm going to tell you about ACT and National, and I'm going to say that unashamedly. And that is my brand, and that's what GRA represents. So I'm being very transparent about it. So with that in mind, with the horrible bias that I disclose, and the transparency that I'm giving you, I've created this grid, and it's going through the different property investors' perspectives of what the four parties are providing. If we look at Labour, their position on interest non-deduction rules is there's no change. They brought them in. They think they're great. In fact, they've told us that they want to reduce depreciation of commercial property. In the last couple of weeks, they've come out with that policy. Anthony, did you clock that? Their fruit and veg?
No, I hadn't seen that, no.
Yeah, well, their fruit and veg, pulling GST off fruit and veg, I understand that they're wanting to fund the benefit of that they perceive that is coming out of that with pulling depreciation of commercial property.
I did see a headline. I saw that yesterday and hadn't gone into that.
Yeah,
okay,
I dug into it either. But anyway, they're very happy with their interest on deduction rules. So I score them out of 10 being the most pro investor, and -10 being the worst. And we're going to give them a -10 on interest on deduction. For loss ring fencing, they're not going to change that. So we're going to give them a -10. The bright line rules, they're very happy with those at 10 years. So we're going to give them a -10 on that. The capital gains tax and wealth tax, they want it. We know they're gagging for it, but they know it's political suicide. So we'll give them I guess, the kudos for being politically astute enough to know that if they do that, they'll really lose some votes. But we know they want it. For tenancy laws, if you're a landlord, you know that your best defence against a tenant who wasn't paying their bills and who was giving their neighbours trouble and who was just a difficult tenant, the best defence was to remove them from the property and just say, well, we're giving you 90 days notice, see you later. And Labour, of course, had issue with that, so they've stopped us being able to do that. Now you can only boot a tenant out if you're wanting to move family in, or if you're selling the property, or if you're going to reconstruct it or knock it down and build a block of flats or something. So it's very limited ways for you to get a tenant out of a property these days, and it's making it very difficult to manage the harder tenants. So I'm going to give -10 for that. So Labour on my list of people that I don't like for how they're treating property people, and they get a score of -50 and an F-. So as I said, no political bias whatsoever. We go through the Greens and pretty much exactly the same, except they want a wealth tax, which is just terrible for us because it's a tax on capital gains that are not realised. And so if you think you're bleeding cash with interest on deduction and high interest rates, paying tax on the net yield, not net cash flow, well, the Greens on top of that want to put a deemed rate of return on our equity and 3-4% and then tax it. And so that's just terrible from a cash flow perspective, and it will scare a whole bunch of capital out of the country. That's just crazy stuff. I can see the argument for capital gains taxes, and there is a good argument for them. but unrealised capital gains, taxing them is very tough, especially with interest on deduction rules, which are interest on deduction rules are a capital gains tax drag anyway. They're effectively taxing capital there with the effect of those rules. So no surprise there, the Greens and Labor are not our friends as investors. National have said for interest non-deduction rules that they will revoke them, and early on, 2022, they were saying that, and now more recently, they're using these words phased out, which is a bit of a slap in the face, to be honest, because clearly they're saying that they're going to take them out as the fiscal constraints in the government allow. So they're really starting to give themselves some leeway to either retain the interest non-deduction rules or to slowly take them out. ACT have said they'll repeal them. So we're going to give ACT 10 on 10, and we're going to give the National Party the benefit of the doubt and say, well, at least I'll take them out. It's just over what time period. So next week I have David Seymour, not next week, in about a month I've got David Seymour, and I'm going to corner him and reconfirm his position. And then a couple of weeks later, or it might be a week later, I've got Nicola Willis and Paul Goldsmith. And that's where I'll actually be able to answer your questions on what National's policy actually is on these interest on deduction rules. And that's when we'll all get the opportunity as a group to spark up against these people in National, because if they're going to slap us in the face and not take those rules out, which they said they would for the last couple of years, then I think we all need to let them know that we're strong ACT voters on the basis of that. And we need to tell our mates that too, because it is a slap in the face. They said that they would take them out. So we'll watch that, but I don't think we should hang them yet because they haven't actually clarified their policy. So we'll get the opportunity to do that in a month or so when Nicola's talking to me. Loss ring fencing, Seymour says he'll consider pulling those out if the budget allows, which is probably a no. And National saying that they plan to keep them essentially at this stage. Now, Brightline, this is interesting because I don't agree with ACT or National here. With Brightline rules, they've set them, National said that they'll reset them at 2 years, and ACT says they'll abolish them. And I think that's tough on IRD, and it's not good for deterrence in the tax base for misbehaving, because we know as accountants that, especially with foreign investors, they sell the property 1 day after the Brightline period. That's their modus operandi. And in the absence of Brightline rule, of course, tax on property in New Zealand is an intention-based test. So what was your intention? You bought this property, it went up in value 200,000, you changed your mind, you're no longer an investor, you said you were an investor, you changed your mind, you're no longer an investor, and you've made $200,000, no tax to pay because there's no capital gains tax, and you changed your mind based on that intention, that stated intention. So people change their mind a lot, and they buy a house, they rent it out, there's privet next door, and the tenants were getting asthma. So it was not a good rental property. So they had to sell that one and bank 200,000 and then buy another one, and it went up 200,000, and they changed their mind again, and because they had nasty neighbours and so on and so forth. So very hard for the IRD, and I don't think it's a good thing for the tax base that we don't have a Brightline rule. If you set it at 2 years, everyone holds their breath and waits 2 years. If you set it at 10 years, I think it genuinely catches genuine change of circumstances, and it's too long. And I think the sweet spot is 5 years. So that's why I've said here, GRA say 5 years is best, because it weeds out the clandestine traders who are acquiescing as investors, pretending to be investors, but they're not really. And it gives most people a window that they can live with without catching people with unanticipated consequences. Having said that, I do think that there's room to tweak these rules. For example, people being caught with 2 homes because they go and live overseas and come back, and their family home has been rented for a while, and suddenly they have to pay tax on it because it's been rented out. I don't think that the rules are right in that regard. And Anthony's got a lot of detail on that stuff. Do you have any comment on that, Anthony, around family homes and the way they've been?
Well, not much, because I don't want to get into a long-winded analysis of the evolving main home exemption rules, but I agree that there should be a bright line rule, because the IRD does need a hand, and I think it's a good thing for the tax base and the property market for there to be some legislation around that. But I think that there should be more compassion in the main home exemption. I think that there are too many scenarios where people buy property with genuine, verifiable intention for it to be their home, and their circumstances change before that can happen, and they can get hit pretty hard by the bright line rule in a situation where, in my opinion, they shouldn't be.
Yeah. So a bit of tweaking could be good. But National and ACT don't seem to have dug too deeply into it. They just, David just wants to abolish them, and National want to set them at 2 years. So CGT, neither of them are proposing CGT or a wealth tax, so that's great. And tenancy law, my understanding is that National will modify and allow no cause terminations of tenancies, which is great, and ACT are doing that too. But I have written to them and asked them to confirm that in writing, and I will ask them that when I talk to them in a month. And there you have it. Now, there's a few comments sparked up on there. Developers and traders have 10 years anyway, 5 years for others is fine, says Paul. Agreed. Tax question associated to the rollover relief provisions. Well, we're going to get to those, Evan, so I'll defer that question. A new kitchen gets a tenant out, by the way. Oh, well said, Paul. Didn't know that. Yeah, I suppose if you're going to put a new kitchen in, the tenant needs to get out. Well said. Why are you not including other minor parties other than Greens Act, such as New Zealand First, New Zealand Oil, NNB? Because I'm horribly biased, Wayne, and I don't care. I'm just dealing with the main ones, and possibly New Zealand First should come in because they'll come up in the polls, and the other ones are not going to get 5%. Actually, I'll pause and say this. If you vote for a minor party that's not going to get 5%, you really do your vote a disservice, because your vote gets wasted. If the party you're voting for is not going to get 5%, it gets prorated across the parties that do get 5%. And so actually you have no voice. You waste your vote. So I'm a big fan of saying to people, don't vote for the minors, vote for the parties that are going to get 5% or more. And as I said, I'm not here to give you a deep dive into all of the political parties. I'm here to talk about National Act, because I do believe that they will give the biggest impact that we need for property investors, and I definitely represent property investors as a brand and as a political person in the landscape. So here's a tax question. Tax associated with rollover relief. Oh no, we've talked about that. National mentioned that interest non-deductibility policy will only be phased out. Yes, Catherine, as discussed, we're going to bail Nicola Willis up on that one. Jackie says, what if you've got no beneficiaries or they're much older? Anthony, pay tax?
Yeah. Well, I guess it depends where the income's coming from. If it's coming from a company, then you could defer declaring dividends. But yeah, there's no secret source there. If the trust doesn't have beneficiaries that are subject to lower rates, then you're going to pay tax. But bear in mind that the individual, say you only have one beneficiary, for example, who can receive a distribution of beneficiary income. Now, they might be earning, say, $100,000 from other sources. And in the past, you wouldn't have bothered allocating income to them because it was a zero-sum game. The trust would pay tax at 33%, and if you allocated income to the individual, they'd pay tax at 33%. But moving forward, if you've got an individual who's earning $100,000, then there's benefit in allocating up to $80,000 to them. Basically, there's benefit in allocating income to individuals to take their income up to $180,000, because then you will save the 6% tax hike that trusts are going to be subject to. So there's more scope, I suppose, for making larger allocations of income to beneficiaries, because there's now a case for filling the gap between what they earn and $180,000.
And that gives larger scope for them to later call up the loans, doesn't it? So more risk of that. Joanne says, can nieces and nephews receive trust income where one has no children? So Joanne, the answer to that is, are your nieces and nephews a beneficiary of the trust? Because you can only make beneficiary distributions to beneficiaries. So if you had no children and you'd made your sister or brother's children beneficiaries of your trust, then yes, you could make distributions to them. But for the same arguments that Anthony just made, I would repeat, you want to make sure that you don't allocate income to the kids and tip them into the higher tax bracket, and they end up paying more tax because you were absorbing their lower tax bracket. Thank you, Wayne. I see your comment there. He agrees with my synopsis. What is the difference between no plan to change and no change anyway? Why score the difference? Well, I agree with that there. I thought I was being a bit tough myself. This grid is a bit tongue-in-cheek, and obviously I am taking the piss of it, and it's not intended to be an unbiased analysis. It's a bit of a joke, actually. And it raises the points, doesn't it? It highlights what's going on politically. And if you don't know where I sit politically, there you do.
You do.
Anthony, what do we do about these changes?
Prior to 31 March 2024, you are now incentivized to clear out retained earnings. So if you have a company that has earned money over time and you've retained that in the company at 28%, now's the time to think about biting the bullet and declaring a dividend while the trust rate tax rate is still 33%. If you're going to do that, you need to bear in mind that there will be withholding tax paid on the 20th of the month following the declaration of the dividend. So if you declare the dividend in March, for example, on the 20th of April, you'll pay the 5% resident withholding tax. You need to plan for that cash flow wise. But that's something that you should definitely be looking at, because if you're going to need the money out of the company in the short term, then you are going to want to look at declaring a dividend in this short space of time that still exists while the trust tax rate is 33%. And I think we've got a slide here, although I think we've probably made this point well enough, but we've got a slide here that compares the difference between declaring a dividend, albeit a very large one here, of accumulated profit over time, declaring it prior to 31 March 2024, where the net tax impact will be 33%, versus declaring it after 1 April 2024, when an additional 6% tax will be paid.
And I think it's important to say there that, that might be 10 years of retained earnings. So a business has been making $250,000 a year after tax retained and then distributing the rest. Or it might be $125,000 for 20 years. And so you've got to make a call. Do you think that these tax rates are going to stay up at 39%? And so if you were to perceive that there's a whole bunch of public debt that needs to be paid off and that the government's going to need to tax New Zealand harder for a longer period to pay that debt down, then you might think, well, if I want to access my money in the future, tax rates are going to stay high, so it's a good idea to do it. If you're alternatively thinking, well, eventually the government will drop the tax rates again, so maybe there's no urgency if I don't even need to pull the money out. If it's business as usual and I can leave the money inside the company, there's no urgency to do this, play the long game. Maybe over the next 10 years, tax rates will drop again. So all of that's in the mix, and we can't tell you what future governments are going to do, but that's something that you can be thinking about. And for, I think, most taxpayers, they'll be declaring their dividends out prior to 31 March. Don't ring your accountant on the 31st of March next year. You really want to be doing this stuff in first quarter next year, because the accountant's going to be super busy and they may not be able to get it done for you in time. Yeah.
Beyond that, we've already talked about income splitting to beneficiaries, and we've talked about wholly owned groups. So we think that that'll be a bit of a go-to structure moving forward. Some other little strategies that you might think about: if you've got expenses that you are weighing up, they're not absolutely critical that you incur them. Say, for example, repairs and maintenance on a rental property, then you might push that out until after 1 April 2024, when the effective tax rebate on the R&M increases as a result of the trust tax rate increasing. On the other hand, if you have income that you can bring forward so that it occurs prior to 31 March 2024, then you could look to do that.
So, Bill, if you're a lawyer, you could, and you're in litigation, you could send your clients bills on the 31st of March, because if you send them the bill on the 1st of April, you'll get 6% more on it just for the timing. So, and I understand litigators generally tend to bill in their own name, but if you were billing through a company into a trust through your office services entity or something like that, then there's the opportunity to bring the revenue forwards and avoid that marginal rate.
Yeah.
Yes, I guess another thing to think about, Anthony, is I use limited partnerships a lot in my structuring for my own affairs and clients, and I guess they're going to go out of vogue because they're going to be transparent and the money will flow through to the trustee partner. So I guess companies are going to come back in vogue very much for the deferral, and LPs will be into trusts will be less popular. Although, can you have a corporate partner on LP? I suppose you can just make the limited partners companies under trusts.
Mm-hmm. Yep.
But you're sort of undoing the benefit of them, because they allow the loss and profit to flow through untaxed, which lets you offset other profits and losses within your group with untaxed income. So that's the beauty of them. And so I guess I think they'll just be utilised less because of the trust tax rate being 39%. I guess also we're saying here, this is an area you should take advice in, because as you want to move things around, to take advantage, for example, of the corporate tax rate and avoid the trust tax rate, then there are tax consequences of moving them. And one area that's particularly an issue is moving residential property, because when you move the residential property, in many circumstances you reset Brightline and you bring forward the interest on deduction rules, so you lose interest on deduction, you lose interest deductibility immediately the moment you move a residential property, with exception. And the exception is the rollover relief rules that have come in. So, Anthony, can you run us through the rollover relief rules and how they work for residential property?
Sure. Well, let's start with the situation where you did, Matt, where they don't work. Because what an attendee would be thinking right now, I imagine, having heard us talk about how the trust rate's going to 39%, having heard us talk about the company rate at 28%, if an attendee had a portfolio of rental properties sitting in a trust, I imagine they'd be sitting there thinking, can I sell these rental properties to a company so that I can then leverage the company tax rate at 28% and at least defer at 11% tax hit? And what Matthew has just pointed out is if you move properties to what we call an ordinary company, which is the sort of company that gets the benefit of the 28% company tax rate, you don't get the benefit of rollover relief. So the properties will be subject to fresh Brightline periods, which could be as long as 10 years in that ordinary company. Interest that's currently 50% deductible, assuming these properties are not new builds or rented out as social housing. We're just keeping it simple here. If the interest was 50% deductible, it would immediately cease to be deductible. So those, unfortunately, are real barriers to restructuring property that's owned in a trust or owned personally into a company. But on the other hand, say you had a property or portfolio of properties that were owned personally, and you weren't so much fussed necessarily myopically on tax. You're also thinking about asset protection. You're also thinking about the legacy that you leave for your children, and you want those properties to be owned in a trust. Now, if we go back a few years, we wouldn't have been able to help you in that situation, because we would have said to you, well, if you move these properties into a trust, you're going to reset Brightline, which at that stage was 5 years, not as long as what it is now, but still long enough to mean that there was a bit of a disincentive for restructuring. When the Brightline period moved to 10 years, and a little bit of a surprise, it has to be said, a rollover relief regime was simultaneously introduced, acknowledging that if property changes ownership within one's own family structure, so in economic reality, the ownership has not changed, then the Brightline period should not reset. And they had to draw a line somewhere between transactions that get the benefit of this rollover relief and transactions that don't. And I've told you where they drew the line in terms of what doesn't get it, moving property from a trust into a company, or from personal ownership into a company. But what you do get rollover relief on is moving property from individual ownership into a trust. In certain circumstances, moving from a trust back to individual ownership. Now, it's not something we would typically advocate, but sometimes there might be circumstances where that is desirable, and that's possible. It's possible for you to do that, I should say, and get rollover relief from trust to trust. This was always intended to qualify for rollover relief, but in, I guess, practice, that's sort of become a little bit of a trademark of the government. When introducing these tax reforms, they work with too much haste and not enough care. And when the rollover relief provisions were brought in initially, they were intended to apply to trust transfers of property, but the legislation didn't match the intention. That's now been rectified, and resettlements of property from one trust to another can be done with the benefit of rollover relief. So we get rollover relief on transferring property from individual to trust, trust to individual, trust to trust, but not from individual or trust into a company, or vice versa. And that's an ordinary company. LTCs are a different ballgame. So that's a quick 101, Matt, on rollover relief.
Yeah, and I think the moral of the story is, given that the stakes are you lose interest deductibility, you reset Brightline. Brightline could be repealed and disappear. If under the new prospective change of government. So really right now, the prudent thing to do is to sit tight, do nothing, and just see what the new government's going to say and do, because this week you might say, well, we would never move our rental portfolio to a company because we'll reset Brightline. But in 2 months' time, if the government has repealed Brightline, you might say, jump into it, because there's no consequence if the interest on deduction rules are being phased out and there's no Brightline implication. So the change of government's going to be a big factor in this as well. So Evan says, in relation to moving an owner-occupier property into a trust, would you advise shifting an owner-occupier property into the corporate trustee of a trust if at a later date that property will become a rental property, or another approach?
Yeah, but it really depends on the circumstances, doesn't it, Matt?
Yeah, it does.
What we can tell you is that moving it into the trust will not generate any negative tax consequences for you, due to the fact that it was a home and due to the fact that there's rollover relief. So if once it's in the trust and it's rented, there's a better structure, you may be able to migrate to that, but then you'll have to basically work out, is there a better structure? Maybe you've got two 16-year-old twins, and having the rental property in the trust is a good structure because it allows you to split income to them.
Or maybe your income's, not exposed to 360,000 or more for the spouses. So if the spouses are earning 100 grand each, you've still got $80,000 each that you can allocate back to yourselves. So the trust tax rate's not a disadvantage to you. Yep. So it's very much situational, and and as Anthony said, you have kids, but generally the trust is going to be pretty flexible. But for those with a bit more going on, a company is going to be a better outcome. just one thing, you mentioned the corporate trustee of a trust. Of course, that just means you're putting it in the trust, and the trust is using a company as the trustee. That has nothing to do with what tax rate you're going to pay when you're using a corporate trustee. The corporate trustee gives you the trust tax rate because it is the trustee for the trust. So Kesha says, with the intention to build a large rental income, what is the best structure to reduce tax and allow to take over, allow to take and have capital-free tax after the bright line period? I myself would say a company to give you the deferral on your income if it's a large portfolio. And Kesha, there's lots of ways to answer this, but one answer is you might, with a larger portfolio, have a series of companies. You might have 2 or 3 properties in each company, and as you get 10 years down the track, you wind up the first company, all the gains come out tax-free, and you've been paying tax at 28% all the way through, or distributing the income out. That's one approach. Another approach is if your income's not going to exceed the marginal tax rates of the beneficiaries, you can put them straight in the trust and use the marginal tax rates of the beneficiaries to stay out of the 39% tax bracket. There's another approach. Anthony, have you got anything to add to that?
No, I think that's a good summation.
Yep. What happens to overdrawn shareholder current accounts when you do the loan transfer? I think it's a bit detailed, SP, sorry. That's one to email us about. Can we transfer New Zealand assets to overseas trusts where tax is lower? You can, but those overseas trusts are deemed to be tax resident in New Zealand if you control them. So you'll end up paying tax on them here anyway. And if you don't declare them as part of your worldwide income and as a New Zealand tax resident, you'll go to jail for tax evasion. So I don't think you're getting anywhere going overseas. Do you want to add anything to that, Anthony?
A couple of things. Number one, the income's still going to be sourced here. For a start, there was a specific mention of New Zealand assets. So it doesn't matter who owns the New Zealand assets, you're taxed on them here if they're New Zealand assets. And then secondly, Matt makes a good point that the New Zealand international tax regime is relatively sophisticated. And whilst it might be called an overseas trust, the reality is if there's a New Zealand settler, then it's for all intents and purposes, it's indistinguishable from a New Zealand trust. Because New Zealand focuses on the residency of the settlers, not the residency of the trustees.
And then they look through appointals, do they? If you try and use a nominee.
Well, that could be, if you got deeper into avoidance, then yes, that would be a factor as well.
Yeah. And then Ruse asks a very good and obvious question, which we haven't answered, and says, can you comment if ACT or National are looking to reduce the 39% tax rate on trust or personal income tax if elected? And I don't know the answer to that. And it's an obvious question we haven't asked them, and we will in the upcoming interviews of the politicians. Do you know anything about that, Anthony?
Not other than neither of them have said that they will. National, a couple of years ago, I'm pretty sure it was part of their intended tax policy to remove the 39% personal tax rate, but that's subsequently been, as far as I'm aware, that's been removed as part of their promise, no doubt due to budgetary pressure.
And David Seymour's got a 2 tax rate system.
Yeah, of course. Of course, yeah.
17 and something percent. 17 is the lower one and the higher one. And
I think it's 58 actually. Yeah. Fair point. So yes, ACT very much will get rid of it because I'll get rid of all of the tax bands and put in their 2-tier system. But National, I think the status quo will persist for personal rates, other than perhaps that whatever adjustments to the middle marginal bands they're going to do as part of their inflation type band adjustment.
Okay, we'll keep rolling on, I think. So just a reminder that this is a very good structure for mitigating down your tax. If you trade in a company and then invest across into the rental company, then you keep 11% of the money and you get compound interest on that for the debt that you've reduced. So it's very effective. Right, so I think a couple of quick things which I'll rip through, things not to do. First one is company beneficiary distribution. So if you had a trust and you made a company the beneficiary of the trust, then you could, in theory, make distributions from the trust to the company and pay tax at 28%. And under draft rules from the government on the trust tax rate going to 39, they've specifically said that that will be tax avoidance. So good idea, but that's not on the table. The second idea that you might have cooked up that would be a good idea if you thought about this is what's called a dividend strip. And a dividend strip is where you might have a company that's earning $1 million and you sell it to another company. So what you do is you form a holding company, and let's say that the company earning $1 million, you value it at $5 million. So the trust loans $5 million to the holding company to buy the subsidiary engineering company for $5 million. So the trust owned the engineering company, it sold it to a holding company and loaned the holding company $5 million to buy the shares. So that was the valuation on the shares. So now you can declare a dividend at 28% to the holding company. There's no difference in tax rate between the engineering company, the source of the income, and the holding company. So you end up with $720,000 in the holding company, and you can pay that out of the loan up to the trust, stripping the dividend out without paying the withholding tax. So great idea. If you came up with this, can't do it. It's too good to be true. This is called a dividend strip, and it's one of the schemes that have been outlawed. Anthony, what's the background to that being outlawed?
It's just been around for, well, I couldn't even tell you. So this is not the dividend strip rules are not a recent occurrence to deal with the 39% rate.
Yeah, it's old tax law.
They've just long been around, yeah.
It's old tax law from prior periods when there have been differences in tax rates between various entities. So just be aware that these avoidance rules can bite you. So it does make sense to take advice before you start doing your own tax planning and getting too creative. Come see a firm like us that can advise you, keep you out of trouble. These rules that are coming through are subject to select committee approval and review, so they're not final yet. And if we get a change of government, we might get something completely different. So it's all draft at the moment. This is the 39% rules. So something that's relatively new, the Section 21 adjustments, and I'll pass this over to you, Anthony.
So this is something that's popped up on our radar recently, and it is relevant to a specific context. Sometimes you might have a property that you owned for residential purposes. Maybe you lived in it, maybe it was rented residentially. Maybe it was rented short term, but turnover was less than $60,000. In all three of those scenarios, you would not be registered for GST. But then circumstances change, and you're now renting the property out short term if you weren't before, or if you were renting it out short term, your turnover is now above $60,000, and GST registration becomes mandatory. And so what you have is effectively what we call a change of use for GST purposes. You've got a property that wasn't subject to GST that's now subject to GST, or a change of status as far as the property is concerned for GST purposes. And that drags the property into the GST net. That means, for example, when you eventually sell the property in these circumstances, having become registered, you will have to pay GST. So you would think then, in the interest of fairness, and given that GST is generally a symmetrical tax, which means that when there's an output GST to pay, you're able to claim GST on the costs in producing that output, and those are called input claims. And unfortunately, the IRD have a different view when it comes to this symmetry argument, because there's a provision that says if the asset in question has a value less than $5,000, when you convert it to being a GSTable asset, we're not going to give you the change of use claim. And in fact, that $5,000 that I mentioned there, that is now, and that's what it was a couple of years ago. It's now actually increased to $10,000 in the most recent changes. So yes, it's actually $10,000. And we think that's grossly unfair. We also think it's an incorrect interpretation of the law. There used to be, in fairness, there used to be a provision that you couldn't make a change of use claim on an asset that had a cost of less than $5,000, but that was explicitly repealed in 2014, I think it was. And the commentary at the time, clear that the reason why that was repealed was to allow people to claim GST on costs incurred on assets of less than $5,000. And now, even though this other legislation that the IRD are relying on existed at that time, they're now saying that it doesn't allow you to claim the $5,000, which it defies logic to me on a number of fronts, not the least of which is the symmetrical part of it. And then secondly, the fact that there was a change in law designed to specifically allow people to claim GST on these lower value assets when they introduce them into the GST net. It defies logic that they can now construe a law that existed at that time as running counter to that.
Yeah, so there's a few clients being caught out by this. We've had one client, and so we went to another firm that is a specialist in tax, and they weren't aware, and they had a client doing a change of use, and they were astonished. So it is something that's emerging, and I actually think IRD will lose this, and they will back off this, but someone's going to have to take them to task, which means someone's going to have to fund the tax team to take the IRD to task on it. And until then, small taxpayers are going to get bullied by IRD just refusing to pay out the GST and demanding that you pay the GST when you sell the asset. So that's a real frustration. And it's good to be aware of it. So if you've got an Airbnb or a property that you're changing the use of, just be aware of this, because it may be that you really try and avoid change of use by spreading the income out over multiple entities, or not going there at all, for that particular use of the asset, to try and avoid the consequence of not being able to claim the GST on these small chattels and so forth. Anything to add to that, Anthony?
No, that's it.
Yeah. Well, we're going to do Q&A now, but actually, I just wanted to talk about trust, because trust is just being whittled away. We've had the Trustee Act, the Trust Act 2019 come in, which is creating compliance hassles for people. Then we've had the trust disclosure rules come in, which are just nonsense, where we're having to disclose income above $1,000. So you're having to do all sorts of trust disclosures. And those rules came in because the IRD and the government was suspicious that you would try and avoid the 39% tax bracket. And actually, they've just changed the tax rules to 39%, but they haven't got rid of the trust disclosure rules, which are trying to detect tax avoidance, avoiding the 39% tax bracket. So there's all of these niggles that are coming around trusts. The Law Commission has recommended that matrimonial property rules be changed, and that the family court can administer matters pertaining to trusts, whereas it used to be High Court only. Now the family court are involved, and they often know nothing about trusts and make heinous mistakes with them. And that the changes, the matrimonial property rules upcoming, are talking about modifying spouses' rights to get into trust. So really, trusts are just a moving feast of issues, and particularly this Labor government and the Greens don't like trusts. They're really, I think, out to make trusts more difficult. And you can see in the census, when you fill in the census, it wants to know, do you own your family home or other assets in a trust? So the government's fishing for information pertaining to trusts. So you'd have to say, well, a trust worth the hassle, now that there's no difference in tax rate between the marginal tax rate and the top and the trust tax rate? Are they worth the hassle? So I've got very strong views on this, but Anthony, maybe you'd start off talking about, do you think trusts are still valuable as structures?
Yeah, well, the short answer is yes. And there are going to be multiple scenarios and multiple reasons why that's the case. Whilst you make the point, Matt, that there might be some pressure in the context of relationship property on trusts, there's still going to be vehicles that can help protect your assets from other creditor risk. And furthermore, those are, of course, proposed possible changes rather than anything that's actually where the train's on the tracks. So you've still got the asset protection aspects of a trust. You've still got estate planning. If you want the assets you leave behind to your children to be protected, having them passed to a trust is still going to be effective. I can't imagine that the relationship property rule changes are going to, or any changes that might occur would necessarily impact on that. You've got the fact that whatever instruction you might have or direction you have in relation to your estate, it's less challengeable when it's owned in a trust. You can't have people popping up to make claims against your estate because they say that you made a promise to them when they were giving you some help in your older years, in your sunset years. And from a tax point of view, we've already talked about the fact that you still get the ability to income split. So it's true that the trust tax rate will cease to be lower than the highest personal rate, but what's the alternative? Holding shares in companies personally? Then there's only one place the dividends can go in that instance, and that's to you personally. And you've got no discretion year on year as to how much of the dividends is returned as income by you or your spouse. It's locked in. With a trust, you've got discretion year on year. 1 year, you might allocate all of the income to one spouse because they took a year off. The next year, it might be the other spouse that takes the year off. And I think you put those things together and there's still, in most cases, a pretty sound case for the employment of trusts.
Yeah, I mean, I've been helping a couple this year that had a very good business that went on hard times at the end of COVID. There's been management issues and they're facing bankruptcy. And it's quite a big business. And, you know, they're late stage, so they're in their late 60s, early 70s, and it's quite sad to watch. You know, good people, and they put a management team in, and the management team has made mistakes, and that business has ended, and it's ended badly. And, you know, I guess the question you'd say is, well, should they lose their family home? Should they lose their investment property? And should they have a terrible retirement because a company has failed and a business has failed? And the answer to that, let's not look at the moral argument as to whether they should give up every cent or not. The answer to that question has nothing to do with right or wrong. The answer to that question as to whether they get to keep their money or not comes down to structure. And if they own their family home, and if they own their investment properties and their other bits and pieces in their own names, they will not have them. When they go bankrupt, they'll be taken from them and given to the creditors. And if they have robustly set up trusts and tuck these assets away in trusts, they will keep those assets. And I would make the argument that when a creditor deals with a limited liability company, they're not relying on the assets of the directors. They don't even look at what the directors own. They look at the company, the reputation of the business, and they engage with it on that level. So I think your points about asset protection are 100% correct, and trusts are highly effective for asset protection in New Zealand. In fact, one of the best countries in the OECD for trust and asset protection. You know, in New Zealand, you can have effectively full control over the assets without the ownership, and so you can have all the benefit without the risk of ownership from an asset protection perspective. So they're very good. And you made the flexibility over the estate plans and the tax planning points well. And I would say that these are tinkering with the rules. Some of the reasons they're tinkering are valid. The trusts need to be modernised, keep up with the changes that are going on, and other tinkering that's going along is ideological and not necessarily necessary, and it might revert back. But overall, trusts are a very important part of the landscape, and if you don't have your trusts, look out. I often see lawyers criticise trusts, which amazes me because the number one proponent and advocate for a trust should be lawyers. But when you dig into the lawyers that don't like them, it's quite often the lawyers that are in relationship property. They hate trusts because when they sue them, they're difficult to get into. So they hate them because they make their professional lives difficult, not because they don't have a function for asset protection. And others are criticising trusts because they are independent trustees in the trusts, and they are now facing, under the Trust Act 2019, more scrutiny and more liability for their actions as trustees. And so if they're not running a really robust independent trusteeship, they could actually face professional liability. So a lot of lawyers are getting out of trusts for that reason. But don't confuse the lawyer getting out of the trust to protect their ass with the function of the trust and the ability of the trust to protect your ass. That they are very effective. And as a firm, we take people through insolvency and we watch what the banks and the creditors do. And I can't say I've ever seen a trust challenged successfully that's been run properly. So they're very effective for asset protection. So keep your trusts. I think they're good and they're flexible. Let's take 5 or so Q&A questions. I'll just remind you before we whip through these Q&A questions that next week, on the 29th, a couple of weeks' time, we've got a finance update with KPN Mortgages, Chris Peterson and Ryan Smut. So we'll find out what's going on with the finance markets. Then on the 14th of September, I've got David Seymour, and the 26th of September on the Tuesday, I've got Nicola Willis and Paul Goldsmith from National. So that should be good. But let's go through a bit of Q&A. Now you've seen this every week, so I won't repeat it to you. If you want to get some advice from GRA, tax is getting more complex. Just make contact with us through Amy or on our website, info@gra.co.nz. We'd certainly be pleased to give you advice if you need some help. But we'll go through the Q&A now. We'll take 5 or so quick questions and then we'll give up for the night. So Murray says, trusts and high investments, are they effective against the 39% rate, Anthony?
Did it say pie investments, did you say?
Yes.
Yes. So the answer is yes. Pie investments are taxed at a maximum rate of 28%. So if you that applies, to example, for everybody's KiwiSaver. The income that your KiwiSaver scheme earns is taxed at no more than 28%. The same would be if you put your money into a non-KiwiSaver PIE investment. So PIE stands for Portfolio Investment Entity, PIE.
Pritzo says property run trusts are uber powerful. The mere fact that the government is trying to tamper with them points to its superiority. The history of trust precedes the Crusades, and these entities have successfully survived many centuries of scrutiny. Well said, Pritzo. Paul says rental and trading trusts are still great for offsetting profits and losses. If you start making profits in both, you may wish to move. But with triple CFA and DTI, it's basically impossible to change structure anyway. Property investors can't even move their houses now. Well, banking's always an issue, isn't it, Paul? Dead right. Kesha says, for the wholly owned company, is there a liability risk that one trust owning both development company and rental company, does the trust benefit outweigh the tax risk? So I guess the commercial risk you're talking about, Kesha, is the banks taking the shareholders' guarantee from the trustees. And you don't have to do that. So if you've got a rental company and a property trading company and they are both owned by the same trust, you can say to the bank, we'll give you the company guarantee and the director's guarantee, but not the shareholder guarantee. So you've got to structure your debt and structure your risk, and then you avoid that liability risk, because there is no liability to the shareholders if you don't give the creditors and the bankers the guarantee of the shareholders, because a company by definition is limited liability to its shareholders. So I think that answers your question. There's no liability risk through common ownership through one trust, and you can invest into entity, but you have to control the creditors and control the banks. I hope that helps you. Does a dividend distribution from a company have to be to all shareholders and based on their percentage ownership, i.e. can you pay a dividend to one shareholder and not the other, asks Stav. Good question, Stav. Dividend streaming.
Yeah, so there is so it's really a company's office, company's law question there, and I'm not going to profess to know these provisions front and back, but there are provisions in the Companies Act that permit directors to declare non-proportionate dividends. So it is possible, but then there's going to be a secondary question from a tax point of view, which is if there's not a commercial rationale for doing so, and if it appears apparent that there's a tax benefit in doing so, then it may well be viewed as tax avoidance.
Well said. So Brian says, if you have rental properties in an LTC, is it possible to sell the shares in the LTC to a trust? The LTC is owned in personal names, and we are also trustees and beneficiaries of the trust. So I think the real question is, can you get rollover relief on the sale of shares of an LTC to a trust, asks Brian.
Right, yeah, and Brian is a genius, because Brian's pointing out what should be obvious to the people writing the law, which is if moving property that you own personally into a trust qualifies for rollover relief, there should not be a reason in the world why moving shares in an LTC to a trust shouldn't also qualify for rollover relief. But unfortunately, Anthony Lipscombe didn't draft the rollover relief rules, and Brian didn't draft the rollover relief rules. And I submitted on this point, but the legislature, they see it otherwise. And so unfortunately, no, the transfer of shares in an LTC does not qualify for rollover relief. What you can do instead, and this just speaks to the ludicrous nature of preventing rollover relief to applying to transfers of shares, you could move the properties one by one out of the LTC and into the trust, and that qualifies for rollover relief, or can. We're obviously simplifying here. There are some requirements and hoops you have to jump through, but just in principle, you can actually move the properties themselves out of the LTC and into a trust. So it's illogical not to allow you to do it with the shares, but that's the nature of these rules.
So Brian, we can tell you how to do it, but it's not as simple as moving the shares, which would be obviously much easier, because if you move the shares, you don't have to refinance, and you don't have to convey the titles. So it's very practical, and it should be that way, but it's not. Does diluting 20 to 30% of the shares of the asset-rich company trigger bright line? Can it be used to mitigate wealth tax potential? Asks Sushil.
Okay, well, two-part question there. If you move 20% or 30% of the shares, and we're not talking about an LTC here, because if you move any percentage of shares in an LTC, that's a deemed sale of that percentage of the property. So we're talking about a non-LTC, what we call an ordinary company. And if there's a 20 or 30% shareholding change in an ordinary company that owns residential land that's subject to the bright line rule, there is no deemed sale of that proportion of the property. A deemed sale only arises if you move 50% or more of the shares in a 12-month period. As to whether that would help you with the wealth tax, well, we'll just pull out our crystal ball here and work out, it'll predict rather how that will apply. We don't know. We don't know. I think your best bet there is to
the rules
cast
aren't
your vote.
the rules aren't in. Yeah, the rules aren't in, so we need to see the rules, the shape of the rules, before we can answer that question. Max says, would you advise to transfer the only rental in the family trust, which has been in the trust for over 15 years, to an LTC, where there is a portfolio being accumulated, then the family trust only owns the owner-occupier residence and make the trust inactive. This will lower the tax compliance of the family trust and utilise LTC losses. Would the rollover relief apply? So there's lots in that, but if you've got an LTC with losses, Anthony, can you use portfolio rules to allocate trust income down to the LTC losses accumulating in the shareholders' hands?
No. So the property would have to be moved.
Yeah.
As our attendee there suggests. So there definitely some merit in what they're saying there, that if the property were moved out of the trust could be rendered inactive, and that would help from a compliance point of view. If it's then aligned with the rest of their properties, that might allow for some beneficial tax outcomes. But the big thing is, do you get rollover relief? And we can't answer that without looking at the circumstances of the trust, how the property got in the trust, the LTC, who owns it. And then we've also got other issues like depreciation recovery. You don't get rollover relief on that. So you need to think about that. And you also need to investigate and confirm that the property is not tainted or otherwise within the revenue net, because you don't get rollover relief on that either.
Okay, so Stuart says, this is interesting. Hello, Matthew. Sent the query below to Chris Bishop, MP, regarding the NAT's tax policy on interest on deduction rules. It seems pretty damn clear. See email just sent. He says, quote, "We will restore full interest deductibility. That's our policy." Okay, Stuart. Well, for fun, let's do this. I run a property thread. It's a private thread of like-minded peoples. And I think if I play this to you, you can hear it. So have a listen to this. Okay, hopefully you can hear this. Can you hear this, Anthony? Can you hear that when I play it?
No, that's you can hear a little bit of dialogue in the background there, but it's fading in and out.
Try this.
Logic, I'm with you. Jamie, thank you for waiting. Good morning.
Yes, hear that.
Good morning, Christopher. Good morning.
Although a bit muffled there.
Taking my call. I've got a simple question for you, Christopher. It's around the deductibility. I just need some help with it. We all understand that you're going to repeal what we call the landlord tax. However, I've spoken to your health spokesperson, and also Nicola, and what the concern out there in the investor community is the policy. There hasn't been any details around whether it's going to be paid back in. I understand like it's a cost of 800 million for the coffers. When do you think specifically there will be some definitive information around that policy so landlords can structure their business models moving forward?
Yeah, no, very, very good question. I mean, the three things really in the rental space is, first and foremost, the bright line test gets moved from 10 back to 2 years, which I think is important. Yes, we want to unwind the interest deductibility piece. We'll have more to say about that, exactly how we'll do that. Today, I think it's sitting at about, Jamie, I think it's about 50%, isn't it? In terms of it's been a phased implementation. And so we'll have to look into that very closely. But our intention is we want to unwind interest deductibility, absolutely. And we have to get the balance right between landlord and tenant legislation as well. And the reason's pretty simple, is the government was actually advised, don't remove interest deductibility, don't extend the bright line test, because it just adds cost to landlords. It leads to higher rents and therefore more inflation. And that is exactly what has happened. Rents are up $175 a week. And
so I think Jamie was saying, when will it be well with that?
We'll have Nicola will have a stronger view on that before the election. But again, we're at 50% now, and whether we phase it back, because we probably have to manage it that way, I suspect. But we'll have more to say about that before the election and confirm that for everyone.
Yeah, we will.
Sure, Cash. So that is.
I certainly heard that loud and clear. Yeah.
Okay, so that is by no means black and white, Stuart, and I'm suspicious, and so is everybody in the property community. I'm very concerned about that. So we can ask Nicola and Paul, and I've emailed them about it in advance of the session. So and Stuart, you should email Chris Bishop and say, you know, you heard Chris Luxon. Are they backing away from that undertaking? Put some pressure on them. Paul says he's voting ACT. Good on you, Paul. So am I. I've voted National all my life, but I'm concerned about Nationals being soft on this stuff, and ACT is hard on it. So I'm going to go ACT. Everybody do what you want to do, but that's where I'm at. I think we'll wrap it there, actually, because a lot of these questions are pretty case-specific and fact-specific. Look, once again, everybody, thanks for tuning in and listening. And Anthony, thanks so much. You're a very clever man, and always love listening to your interpretation of things. We'll see you in 2 weeks' time for the Chris Peterson KPM Mortgages session with Chris and Ryan Smut. That'll be a good update on the finance side of things. And then after that, we've got the politicians. So stay tuned with us, and we'll look forward to seeing you in a couple of weeks. Thanks again, and see you soon. Good night.
See you later. Thank you.